Hi traders, it's Bruce Banks, and today we're going to talk about 5 rules for an aspiring trader. These are traders who are looking to get into it and are just getting the feel of what trading is about. And there's a few really key things that every trader who's getting into this should know. So the first one is never add to a losing position. I'm sure you've heard this before, but this one is incredibly important. Now let's take a look here and say that we have a long bias on this market. The trader through his analysis has decided that he wants to go long here, or he wants to go long here, and he thinks the market's going to go up. The market has been trading up recently, but there are a few warning signs that, as you've tested out your methods, depending what you use, you're going to see. Like for me, a big warning sign right here is you see that we have a second low here that broke this previous low, so it kind of broke the uptrend. We're going to ignore that sign. We're talking about a new trader here. Says like, I want to take a long position on this. Goes long on the market. And as the market goes down, like you can see here, we have a sharp down in the market. This is quite a sharp move, so most likely news related. As the market goes down, they get a little bit worried. Now, say the market goes down and they see it bottom all the way out. They don't have a stop level, and you let the market go all the way down. Human emotion kicks in there, and that's one of the things we're always fighting with as traders. And as the market starts to go up, they think, oh man, I'm gonna have to do so much to earn my money back. What if the market's going back up now? I can just go ahead and say I'm just gonna add another position on here, so I'll earn the money back, and I can average it down, so I don't even need the market to reach what it previously was when I entered back here. All I need to do is have the market just reach even below that level, and I'll average down. And that's such a big mistake, because if the trade has not gone in the direction that you originally anticipated, you need to just basically get out of the trade. There's no reason to ever average down by adding on positions to a losing trade, because you can see what would happen is they would have added on, and again, they would have just lost even more because they have 2 positions on now, both losing money. And that's how a lot of new traders end up bleeding a lot of money into the market. You have to have your trade idea and go for it. And that goes into rule number 2, using hard stop loss levels. Now, we already briefly touched on why taking a long here is a little bit risky, but say this trader has an idea and it's like, I really, really want to take this trade. I believe the market's going to go up through all of their analysis, whatever strategy they're using, and they take the trade. Now, the most important thing is you have to take a level. Just draw a line. When you enter your trade, before you enter that trade, you have to find a level, and you're just like, okay, this is going to be my hard stop loss level. This is going to be my hard stop here. You have to choose whatever level that you choose. You have to choose that hard stop loss level. And this is especially important for aspiring traders who are just getting into it. That level is golden. That's just as important of a level as your entry. You have to have your hard stop loss level, because the thing is, you can take a losing trade, but a losing trade that is just open-ended without a hard stop loss level can just end up costing you more and more money. It's an open pit. So a hard stop loss level is incredibly important. Number 3 is understand that trading is a long-term plan. You're going to have losing trades, and you're going to have winning trades. You'll have down days and you will have up days. Just because this trader took this long trade and said, okay, I'm going to take it and going to roll with it, and he took a loss on the trade, if he used a proper stop loss level, where as soon as the trade went against the direction that he was betting on, he got out of the trade and he cut his losses as soon as possible. He can take another trade. He doesn't have an open trade bleeding there. And he has to understand that that's just a losing trade. You chalk that up in the pile of that's a loser, and you go for your next trade, which could be a winner. Number 4 is trade with 1 to 2% risk of your capital per trade. So that's total capital. This is a really good rule that you'll hear quoted quite often, because it limits the amount that you can lose on every trade by so much. If you have a $10,000 account, you can't trade like a trader who has a $100,000 account. you might have to scale your position sizing down to meet your actual trades. I've got a video on this that'll pop up in the link above, or it'll be linked below. But it's a really good rule because the whole thing is, if you take a losing trade, it's not account crippling. That's the most important thing about the 1 to 2% rule, is the fact that you can take multiple trades that are losers in a row, which if you're a trader, you have to be willing to accept will happen. But as they happen, it's not that big of a deal because you're always going for winning trades, like a better winning percentage. So losing 1%, losing 2% of your account size on a single trade is not that big of a problem. So no matter, even if you make a complete blunder of a mistake that you can look back on and say, oh yeah, I understand why I shouldn't have made that trade, it's not that big of your account size that it took away, and you'll end up being able to take more trades that way by limiting how much risk you take per trade. And that takes us into point 5. Backtest any strategy that you want to use before you use real money. After our traders spend a good amount of time in the market, they get a bit of market intuition. You understand when you start to see higher highs, higher lows, you start to see points of resistance, points of support. One thing that is key for all trading strategies is the fact that you back test it. You can have a simple strategy saying that, say if you get 2 up bars, like we'll make up a strategy right now. If I get 2 up bars in a row of equal size, I take a long trade. If I get 2 down bars of equal size in a row, I take a short trade. And what you can do is you can quickly and easily test that theory. So you look for that on the chart and say, okay, well, I'm going to test that theory right now. Look for 2 up trades equal here. So I see 2 equal here, that would be an up trade. I see 2 equal here, roughly, that would be a down trade. I look for here, and that's the only ones I'm quickly seeing right now. We'll test that theory. Here would be a long, so we enter here, and possibly could work. We see, we enter here. Oh, no, stops us out right away. So we've tested that theory. That's backtest. That's a super simple backtest. That's a terrible backtest. But I'm saying that what you need to do is you need to be able to take whatever theory you have. That's why I've tested the highs and lows theory, and I really do like trading with highs and lows. But you have to take that theory that you have and back test it religiously, because back testing is basically playing with free money. You're not actually playing with real money. There's amazing back testing software out there as well, where you can use it and you can test your theories before you apply your real money. It's such a easy thing to do because you're learning the market at the same time. If you're an aspiring trader, you're a new trader, you really want to have a better understanding of the market. You want to have a better understanding of how the market moves when there's news announcements that are upcoming, or when there's or during the open of every day. You want to have a better understanding of the market, and backtesting allows you to not only understand the potential trading strategy that you're going to use, but understand the market as a whole. So it's really important to backtest every strategy. That was 5 rules for an aspiring trader, and I hope you got some value out of this.